Welcome, ladies and gentlemen, to the Cima Strategic Case Study Financial Strategy or F3 Essentials Refresher Segment 6 Part 2. This part is a follow-up to mergers and acquisitions where we will be looking at pricing issues and post-transaction considerations. Let's have a look. But before we dig into the content, I'd like to remind you what you should be doing. Please have a notebook and a pen on the ready. Follow the slides and my explanations very carefully. Take notes. Maintain a list of doubts and clarifications. Maintain a list of key topics that you feel you're weak at so you can self-revise later, and make sure that you stay focused. Take short breaks, deep breaths. All of these will help you stay focused. Alright, so pricing issues and post-transaction issues. Now, when it comes to an acquisition or a merger or any sort of deal that goes through inter-company, you have these two aspects to look at. One is obviously the pricing and the funding and the payment, and on the other hand, you have some post-transaction issues also to consider. Now, as far as defenses are concerned, right, because sometimes if you're being targeted, you don't want to really be targeted. You don't want to be acquired. You're very happy with your parent group, right? You are very happy with how the things are at the moment. When you're being targeted, there are obviously pre-bid and post-bid defenses. So the bid is the differentiating point where the acquirer or the bidder is publicly announcing the bid, right, to you, that we want to acquire you. So there are pre-bid and post-bid defenses. And why pre-bid is because you can get a feeling. There are enough and more. We are talking about we were talking about markets and forms of efficiency. So information is always traveling, in a company. So pre-bid defenses, there are obviously the options to communicate effectively with your shareholders, revalue your non-current assets and try to raise them up to drive the price value up, and price non-affordable. You take a poison pill, you do something that is not very healthy to the company and that makes the company unattractive. Change the articles of association to require supermajority approval for a takeover, right? These are some, not all, but some pre-bid defenses that are at your disposal if you don't want to be targeted. Then post-bid defenses, once the bid is made, right, post-bid defenses, you can appeal to their own shareholders or appeal to our shareholders if we are the company that is being targeted, to say do not agree to this. You can attack the bidder, right, publicly through media, right? You can even use a white knight strategy. You go to someone else who has the power, who has the money, who might be willing to listen to you, and who might run things the way you want them to be run. And then of course you have the Pac-Man strategy, right? The famous Sega game, which is also known as a counter bid, right? Once a bid is made to purchase you, what you do is you counter bid saying, no, we want to purchase you, right? How about that? And then you can also refer the bid to competition authorities and see if you can use any aspects with respect to competition to discourage the bid, right, through the means of competition authorities. And that brings me to looking at the form of consideration for a takeover. So the form of consideration is essentially the amount that you're going to pay, and the form is how you're going to the means and the medium of that payment. When one firm acquires another, two questions must be addressed regarding the form of consideration for the takeover. Number one, what form of consideration should be offered? Are you going to go with a cash offer or a share exchange or an earn-out agreement, which are the three main choices which we will look at. The second one is, if a cash offer is to be made, how are we going to raise that cash? The choice is generally debt finance or a rights issue to generate the cash. Now, if the entity does not have enough cash already, that is. All right, let's take a look at these three key options. Number one, form of consideration, cash. In a cash offer, the target company shareholders are offered a fixed cash sum per share. This method is likely to be suitable only for relatively small acquisitions unless the bidding entity has an accumulation of a large amount of cash. Advantages: when the bidder has sufficient cash, the takeover can be achieved very quickly and at a lower cost, because even the bargaining can be done in a way that is favorable to the bidder. Target company shareholders have certainty about the bid's value. That is, there is less risk compared to accepting shares in a bidding company. There is increased liquidity to target company shareholders. That is, accepting cash in a takeover is a good way of realizing an investment because the shareholders are getting money, right? The acceptable consideration is likely to be less than with a share exchange, as there is less risk to target company shareholders. This reduces the overall cost of the bid to the bidding company. So the bidding company is actually in a much more better bargaining power situation where they can negotiate a better deal because they have the cash and they are ready to pay in cash. Disadvantages: with larger acquisitions, the bidder must often borrow in the capital markets or issue new shares in order to raise the cash. That is for the bidder, right? If you want the money and if you don't have it. This may have an adverse effect on gearing and also cost of capital due to the increased financial risk. And for target company shareholders, in some jurisdictions, a taxable chargeable gain will arise if shares are sold for cash, but the gain may not be immediately chargeable to tax under a share exchange, right? So there is a taxable charge that is going because of the cash transaction nature. And the target company shareholders may be unhappy with a cash offer since they are bought out and do not participate in the new group. So the thing about cash offer is, for the target company's shareholders, they only get the money, right? They were previously owners of a company. Now they're getting money and they're owners of nothing, just the money. And for some it might be a attractive option, right? But for some shareholders it might not be. They might actually want to participate in the new company, right? So that is the advantages and the disadvantages, and really a closer look at the cash form of a consideration. Then let's take a look at the second form of consideration, share exchange. In a share exchange, the bidding company issues some new shares and then exchanges them with the target company shareholders. The target company shareholders therefore end up with shares in the bidding company, and the target company's shares all end up in the possession of the bidding company. Large acquisitions almost always involve an exchange of shares in whole or in part. So here what happens is you're offering not cash but shares of the, well, technically the new shares of whatever company that the bidder is from are being offered, and the target company shareholders will ultimately, if they accept, will become owners of the entity itself. Now, advantages: the bidding company does not have to raise the cash, right? So there's little trouble there. The bidding company can bootstrap earnings per share if it has a higher PE ratio than the acquired entity, right? So it's this combination technique of the price to earnings multiple to raise it up. Shareholder capital is increased and gearing is similarly improved as the shareholders of the acquired company become shareholders in the post-acquisition company, right? So shareholder capital overall is increased, gearing is also improved, and shareholders of the target become the shareholders of the post-acquired new company. A share exchange can be used to finance very large acquisitions, right, where there's no need to work with a lot of cash. But disadvantages: one is that the bidding company shareholders have to share future gains with the acquired entity, and the current shareholders will have a lower proportionate control and share in profits of the combined entity than before. Okay, so they might, I mean, the bidders' shareholders might not want to do this, but this is an inevitable thing when it comes to the share exchange form of consideration. And of course, there is the price risk because you're paying through shares, right? And shares have a value which is volatile. There's a value at risk there. There's a risk that the market price of the bidding company shares will fall during the bidding process, which may result in the bid failing. Now, do you remember earlier when we looked at defenses, right? When we looked at pre and post bid defenses, there was this: attack the bidder. Now, what happens when the bidder gets attacked, especially if the attacks are real, right? If the attacks are material, if the attacks are big and negative publicity, all of that, it can lead to the reduction in the price of the bidding company. Right? Price risk. There is a risk that the market price of the bidding company's shares will fall during the bidding process, which may result in the bid failing. See, this is where the attack, if at all it works, this is how it happens. For example, if one for two share exchange is offered based on the fact that the bidding company shares are worth approximately double the value of the target company shares, the bid might fail if the value of the bidding company's shares falls before the acceptance date. Right? So share for share exchange, there are a number of benefits, but this price risk can turn things around. Then the third form of consideration is what you refer to as an earn-out arrangement. An earn-out arrangement is a procedure whereby owners and managers of selling an entity receive a portion of their consideration linked to the financial performance of the business during a specified period after the sale. So, owners and managers of the entity have a portion of their consideration linked to financial performance. So, it's not, you have to earn it, right? It's not paid out at the offset, at the initial stages when the deal goes through, it's not paid out. The arrangement gives a measure of security to the new owners who pass some of the financial risk associated with the purchase of a new entity to the sellers. The purchase consideration is sometimes structured so that there is an initial amount paid at the time of acquisition and the balance is deferred, right? The balance is paid out in stages, especially as they are linked to financial performance targets. Some of the deferred balance will usually only become payable if the target entity achieves specified performance targets. Earn-out arrangements are often employed when the buyers and sellers disagree about the expected growth and future performance of the target company. A typical earn-out takes place over a 3 to 5 year period after the acquisition and may involve 10% to 50% of the purchase price being deferred and paid across during that period. Right? So 10% to 50% of the price can be deferred. Earnouts are popular among private equity investors who do not necessarily have the expertise to run a target business after acquiring it, as a way of keeping the previous owners involved following the acquisition. Right? So this is definitely a way to keep the previous owners or the incumbent managers interested in the going concern and the success of the company that has been established newly. Next, we look at methods of financing a cash offer. So obviously it's the general funding techniques. If the bidding company has a large cash surplus, it might be able to make a cash offer without raising any new finance. But in most cases, this will not be the case. So various financing options will have to be considered by the bidding company. The main two options are debt or a rights issue. If target entity debt has to be repaid, the bidding company's total cash requirement will need to cover the cost of purchasing the equity shares and the value of the target entity debt. So that is a large commitment, right? Total cash requirement to cover the cost of purchasing the equity shares and the value of the target entity debt. So obviously one option is debt. The bidding company could borrow the required cash from the bank or issue bonds in the capital markets. The advantage of using debt is the low cost of servicing the debt, but raising new debt finance will increase the bidding company's gearing. This will increase the risk to the bidding company shareholders, so it might not be acceptable to the shareholders, or they might want bigger returns, and as a result cost of equity can go up, weighted average cost of capital can go up, and this can lead to negative influences. Obviously you can go for a rights issue. If the bidding company shareholders do not want to suffer the increased risk which debt finance would bring, the alternative would be for the bidding company to offer a rights issue to its existing shareholders. The funds raised can then be used to buy the shares in the company being acquired. Gearing levels are thereby protected. From the shareholders' point of view, the problem with this financing option is that it is the shareholders themselves who have to find the money to invest. Right? So you can announce a rights issue, but shareholders, the existing shareholders will obviously are the ones who have those rights, and if they want to buy them, and they will have to find the money to invest, and that money will in turn be used to fund the merger or the acquisition or the deal. Right? So these are some of the methods available to financing a cash offer. Right. Next, how do you treat target entity's debt? A material adverse change clause is often used to make the target entity's borrowings repayable if the company is sold. Therefore, When you consider how to fund a takeover, right? When you're looking at the financing strategy of a takeover or a merger or an acquisition, the bidding company will have to ensure that there are sufficient funds available to purchase the shares from the target entity shareholders and to repay the debt in the target entity. So that is very important because the debt financiers also have a say in this whole thing. Then the post-merger or post-acquisition integration process. Now, if you remember in the first segment of, in the first part of this segment, we looked at why M&As can fail. And one of the reasons is the lack of integration, right? Is the failure of successful integration. Now, Peter Drucker in 1981 identified 5 golden rules to apply to post-acquisition integration. Drucker said, 1. You have to ensure a common core of unity is shared by the acquired entity and the acquirer. Shared technologies or markets are an essential element. So a common core of unity can be established. The acquirer should not just think what is in it for us, but also what can we offer them. Right? That is a good question to ask. The acquirer must treat the products, markets, and customers of the acquired entity with respect. Within 1 year, the acquirer should provide appropriately skilled top management for the acquired company. So good leadership has to be provided. And within 1 year, the acquirer should make several cross-entity promotions of staff. These are the 5 golden rules that Drucker identified for a merger, for a post-merger or a post-acquisition integration process to be successful, right? And on that note, we will be looking at how do we enhance value, right? And these could even lead to realizations of synergies. How do we enhance value? What are the strategies that are available post-acquisition to enhance value? Key points to consider when determining strategy. So the integration strategy must be in place before the acquisition is finalized. You know, there's so much of due diligence, so much of time that you take before you actually go for a deal, right? There's a lot of money involved. So in that time, you can have the integration strategy in place. Review each of the business units for potential cost-cutting, synergies, or potential asset disposals. It is possible there are outlets more valuable to another entity, but it is important they are in good shape before they are sold. However, more than this is needed for a full effective enhancement program, and a position audit could be carried out. Right, so there's a lot of post-acquisition work that you can do. Consider the effect on the workforce and determine how many, if any, redundancies are likely and what the cost will be or the benefit. Then risk diversification may well lower the cost of capital and therefore increase the value of the entity. So you look at how you can diversify the risk. The entity's cost of capital should be reevaluated, most definitely. Make a positive effort to communicate the post-acquisition intentions within the entity to prevent demotivation and avoid adverse post-acquisition effects on staff morale. There also may be economies of scale to identify and evaluate. Undertake a review of assets or resource audit and consider selling non-core elements or redundant assets, right? So you can look at divestment, spin-offs. Just review the assets, do a resource audit, look at what the best options are, especially with respect to non-competent or non-core elements of the business. There may well be need to pursue a more aggressive marketing strategy. So look at if you need to really invest further and aggressively push products and help the new entity or the acquired entity push the products and reach to more customers. The risks of the acquisition also need to be evaluated, and there needs to be harmonization of corporate objectives. Goal congruence is important, right? Because lack of goal congruence, if you remember, was identified as a key factor for why M&As fail. So these are post-acquisition value enhancing strategies. On that note, we have a couple of other factors to consider as well. One is the impact on ratios or performance measures. Following the completion of an acquisition, the purchaser will need to examine thoroughly the financial and management accounting records of each business unit of the acquired entity, because anyway in the due diligence process you can't be 200% sure that you have got the full view of the business. Only once you acquire you will be privy to information. I have first-hand experience related to, I was associated to a due diligence team of a company that my company at the time was looking to acquire, and we realized after the deal went through that things were not as rainbows and sunshines as we thought. Thus, the directors of the acquirer will be particularly interested in the financial condition of those units which they might plan to dispose of. Right? The other consideration is the impact of an acquisition on the acquirer's post-acquisition share price, on the bidder's share price. A very important aspect for an acquirer or a bidder is the post-acquisition effect on its EPS and the impact on the share price and the PE ratio arising from the market's perceived views on the acquisition. Right? So, impact on financial ratios, performance measures, KPIs, and post-acquisition share price, EPS, PE multiples, all of these are important factors to consider when you are looking at a deal, completing a deal, and post-acquisition aspects. And that marks the end of segment 6 part 2, right, which we looked at about post-acquisition transactions, pricing issues related to M&As. As I always remind you, keep working while having fun, and ideally this is the completion of, if you have watched all of the videos, it means that you have basically revised the entire financial strategy at a level that even a F3 OTQ student would do. Even if you're an OTQ student, the only additional work that you have to do if you have gone through the videos is doing the numbers. But these are designed specifically for case study students, and as case study students you are good to go as far as financial strategy knowledge is concerned. You have very well revised. If you have engaged with the videos, you have very well revised all the necessary content, basically the entire syllabus, in a matter of a few hours, that are essential with confidence going into the strategic case study. So congratulations on completing all the segments. Keep smiling, keep working, and keep learning. I will probably see you soon in live sessions, in recordings, and make sure that you engage with the content in the most productive sense, and you bring any doubts, any clarifications, any discussion points. We will go through them. We will discuss about any matters that you want to discuss, especially in the case study live sessions. I am looking forward to seeing you there. Good luck and thank you.